Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today, what we are looking at my portfolio, we are looking at 3 of the 24 companies that I currently own. And one of these is one of the largest positions in my portfolio, and it currently is the largest payer. We're going to be looking at WP Carey. We're going to be looking at the earnings report that they just came out with. We have some articles pulled up right here. We'll be showcasing that for the end of the video, because about all 3 of these that I'm about to show you, this is what I'm most excited about. WP Carey came out with some awesome news, and I'll likely be looking to make an increase in my portfolio for WP Carey. I'm still looking around to make some moves, so stay tuned, but I haven't changed anything yet, but I'll likely be increasing my position even more in WP Carey. There are 2 other companies that we're going to be talking about in this video, and the one that we'll be starting off with is Pepsico. Pepsi did just raise its dividend another 5%, and this company has projections that look even better in 2021 than what it has in previous years. So I'm going to tell you why Pepsi is looking better and brighter than ever, and why I'm so confident in this investment, and why it continues to be one of my favorite companies to own as both a consumer and an investor. And then last but not least, there will be another company we'll be going over, the one that is most recent in my portfolio. I've been talking about this company a lot over the last month or two, and I'll be going over some numbers that was just released for Lockheed Martin and why this company is at an absolute steal. And I mean an absolute rock bottom prices for what it is currently trading at compared to what its normal price is worth. And I just increased this in my portfolio. I originally started at, I believe, 2 or 3% of my portfolio. Now I've got it up to 4, considering even bumping it up to 5 if it were to go any lower. But all 3 of these companies have a lot of value, and I'll go over in this video why all 3 of these are excellent companies to own and why I'll continue to own and buy more of them in 2021. Before we dive into all of that, if you're not familiar with me, my name is Jordan. I'm the Millennial Investor. These are the 24 companies that I currently own in this column, in column A right here. And if you look, I track my annual and monthly dividend income through these 2 charts. My annual dividend income on the left, my monthly dividend income on the right, and these are updated every single month. And speaking of charts that are updating every single month, we also update my portfolio value and my monthly YouTube income. So these are also updated monthly as well, and I disclose everything in the channels from buys to sells, to changes in my portfolio, to dividend payments, to referrals, M1 Finance, and these are my investing goals and my stock market prediction for 2021. And speaking of one of those goals and referrals to M1 Finance, you see this goal number 4 right here. One of those goals is to get 150 people sign up with M1 Finance. And over the weekend, we finally hit 90. 90 people have now signed up, and people have been getting signed up with this link like crazy. And the reason is because right now, M1 Finance is having a promotion where you get $30 just for getting signed up. So all you got to do is download using this link and put $100 to the platform, and you get a free $30. It's that simple, no work whatsoever. It's no risk, it's a free brokerage, there's nothing to lose here. So if you want to use that link, if you want to support the channel and get a free $30 for doing so, you can go ahead and use that link. And if you want to see my portfolio firsthand, this link is also down below in the description, as well as lots of other things like mentoring calls, yada savings accounts, credit card referrals, and lots of other things as well. But let's go ahead and get into the first one that we're going to be talking about, which currently makes up 5% of my portfolio. And it currently has a target percentage of 5%, and it makes up 4.5% of my portfolio. And we are down $1.33, or 0.56% in the money weighted return. We've earned about $5 worth of dividends, but right now we're currently down about $6 in market gain. Man, earnings are weird. Sometimes they come out with great news, and the things that I'm looking for are sometimes just completely different than what traders or analysts are looking for. But the numbers that this company just came out with are very, very good. And based off the dividend yield that it was before of 1.0225 times 4, $4.09 a year, and divide that by the current share price of $133.87, it currently has a dividend yield as of Friday's close of 3.05%, 3.06% actually, sorry about that. And they just raised it again, so that dividend yield is now well over into the 3% range, and Pepsi says that revenue jumped 8.8% in 2020, and it also sees 2021 results meeting long-term targets. And let's go over some of the specifics about what it means by that. PepsiCo on Thursday reported fourth quarter earnings that topped estimates, fueled by pandemic snacking and higher sales of drinks like Gatorade Zero and bubbly sparkling water. Which, speaking of which, bubbly sparkling water, I've talked about this a lot recently as well. Another high growth category. I expect bubbly and the new Rockstar Energy brand that they just acquired, I expect those two to be very high growers in this category. I really like the 2 brands that they have right there. Shares of the company fell less than 1% in morning trading. Pepsi stock has fallen 6% over the last year, giving it a market value of $189 billion. But if we look at the earnings per share and the revenue, they were awesome. They came in at very good levels. Earnings per share of $147 versus $146 expected, and revenue of $22.46 billion versus the analyst estimates of 21.78. So they beat revenue by almost $1 billion, and they also beat by a penny on earnings per share. Now this line right here, which is most important to me, this top line, earnings per share, is far more important to me than revenue. Not that revenue isn't important, but EPS is what I'm really looking for. $1.47. Let's go back here. You see these little D's, the little D's that represent dividend payments. And like I said, as of before this raise, they were paying out $1.02 every single quarter. So that means every quarter, if they don't report at least $1.02, then they can't afford to pay that dividend. So I need this company producing more than that. I need this company to produce things like $1.10, $1.20, $1.30, $1.50. And this company, as of last quarter, was producing $1.47. So when you think about that, when they're only paying out $1.02, but they're producing $1.47, that still leaves about 45 cents of earnings per share to reinvest back into the company for capital expenditures, to pay down long-term debt, to do whatever they want to do with that extra cash. Maybe they just want to keep extra cash on the balance sheet for a rainy day. Whatever the choice is, whether they keep it in cash, they increase shareholder value by raising dividends, buying back its shares, reinvest back into the business. When a company like this is this profitable, eventually, regardless of what the share price does over the next coming years, the dividend will steadily increase. And more than likely, when you have a company that continues to increase profitability year after year after year, more than likely this share price will eventually follow suit. Don't be surprised if a couple of years from now we're looking at Pepsi being a $200, $300 stock. Now that might be next 6 months, it might be 5 years from now, who knows, but regardless, I'm betting on this company. And when you look at some of those brands like I was talking about, the pandemic-fueled snacking they called it, look at some of these brands that they own. These are some of their top brands. They have brands that are in beverages, they have brands that are in food categories, but if you go to just some of their top global brands, look at some of these top names. You probably see these every single day. Pepsi, Lay's, Mountain Dew, my favorite, Doritos, Gatorade, Tropicana, Quaker Oats. The list goes on and on. They have so many huge brands that it's hard to see that this company really fails in the long term. So this is what gets me excited as an investor, raising that dividend, increased profitability, increased revenues, and this is why I intend to never sell a single share of this company. I am so bullish on this company for the long term. I love them as an investor, I love them as a consumer, and I don't intend on selling them anytime soon. But moving forward, let's go to the next company that we're going to talk about, and it's the one that's a new addition to my portfolio. And I think that this company is trading at, well, some of the best prices that you could have possibly bought this company at on a valuation basis, probably within the last half decade. We're looking at a stock that makes up 4% of my portfolio. That's the target percentage right here. And I'm currently down $21.61, and the money-weighted return is negative 7.61. So I'm currently down on this stock. And it is a recently added position, like I said, and I currently have about $400 invested into this company. And I currently own a little over 1 share. I own it at an average share price of $3.58 on the dot. And if we look at this company has steadily downtrended over the last year. Now, before you know anything about it, what the company does, what its business model is, what their numbers look like, you would probably think that if you look right here, if you look to mid to late 2019 or early 2020, you've seen that this company has pretty much traded flat, even downtrended over the last year or so. And even since then, this is trading at lower value than what it was trading at in early 2018 and late 2017. This company is trading at rock bottom prices. Now, since then, including the 2020 pandemic, this company has continued to increase revenues and increase profitability. And if we look over the past week, this company just reported earnings. And if you look, pretty much traded flat, went nowhere. It started out the week at $337.50 and it finished out the week at $337.73. And when I look at no price movements, but I look at numbers like this is where I see value as a dividend investor. When people in the market are not valuing this company the way that they should be. If this company, what is it trading at right now? $337. If this company went up to $400 a share tomorrow, I would still be buying it because this company even has a lot of value at $400 a share. If this company was even in the mid 400s, I would still say it's a pretty decent buy. But considering that it's in the low 300s, I think that this company has an awesome opportunity, and let's go ahead and look at some of the numbers why that is. Now, Lockheed Martin. Lockheed Martin came up with some incredible numbers for 2020. And if we look at that, let's quickly glance over these numbers and the projections from 2019 to 2020 and what that's going to look like in the future for 2021. Now let's look at net sales, so revenues. In 2019, these numbers are in millions by the way, they did almost $60 billion, okay? They increased that the next year in 2020, they finished out the year at $65 billion. So over a $5 billion increase year over year. Now what are they looking at expecting doing in 2021? In 2020, they did $65 billion. In 2021, they expect 67 to 68. So once again, they're expecting $2 to $3 billion. That's with the letter B, not an M, not million, billion dollars more than they did in 2020. Now let's go ahead and look at other projections. What's the next category? We have business segment operating profit. If we go right here, right on this line, 6,500 is what they did in 2019, so 6.5 billion. And then in 2020, they did 7.1 billion. Once again, about a $600 million increase. So they did 7.1 billion in 2020. What do they expect to do in 2021? From 7.1 billion, they expect to do about 7.3, 7.4. Once again, a couple $100 million increase. The next two that I want to look at, and I'll save the best for last, let's look at cash from operations. If we look at cash from operations, this number right here, in 2019, they produced about 7.3 billion in cash from their operations in 2019. They increased that to 8.1 billion, an $800 million increase. 8.1 billion, and they're projected to do over 8.3 in 2021. Once again, another beat. And then last but not least, we have the diluted earnings per share, the EPS number. Just like I said with Pepsi, this is what I look for the most. This is what's most important to me. If I had to ignore any of these numbers and just look at one line, this, in my opinion, as a dividend growth investor, this is what I want to see. I want to see this number increasing. Now, obviously, I look at other things like the revenues, the net sales, the operating profit, the cash from operations. Those things are important, but this line right here is what is most important to me. As long as I see this number increasing, that's what I want to see. Diluted earnings per share. Let's go to the 2019 numbers. Where are we at? Diluted earnings per share. They produced about $22 per share in 2019. They went up to $24 per share and 30 cents in 2020. That's about a 10% increase, almost a 10% increase. And if we go back to what the projected is for 2021, they're projected to do over $26 a share, another $2 per share increase. And that is why this company was just able to raise its dividend another about 10% just in 2020. And they're looking at raising it again in 2021 even more. And when I look at this company and I see that the company is now more profitable, has more revenues now than they ever have, and just because people are worried about the blue wave that, oh, they might reduce the spending budget for the defense contracts, this company is nowhere near losing any of the competitive edge that it has over its competitors. This company is trading at a valuation that is so underappreciated. This company should be at least, like I said, $400 a share. And just look at the dividend growth for this company. If that doesn't impress you enough, let's go ahead and look real quick. What's the yield of this company? So right now, on a quarter per quarter basis, they pay $2.60 for every share that you own. So take 2.60 and multiply that times 4. They'll pay out $10.40 a year to shareholders. So take 10.4, divide by today's share price of $337.73, and right now, as of today, they have a dividend yield of 3.08%, over a 3% yielder. And once again, they are far more profitable than ever, more revenues than ever, and they're looking at raising that dividend again, probably another close to 10%. And this is why this dividend has went from $165 to $182 to $2 to $2.20 to $2.40 to $2.60. Do you see how rapid the growth is for this dividend? It's not going to stop anytime soon, and this company has such a competitive edge, and it has the most important customer in the world, and that's the United States government. The United States military, specifically the Air Force, relies so heavily on Lockheed Martin. I believe it's something like 70% of all aircraft comes from Lockheed Martin. They have such a dominant position towards the government, this company does, and this is why I'm betting on this company for the long term. This is a company that I don't know if it'll be a lifetime stock. A lot could change with the defense budget and the way the military looks over the next couple of decades. But this is a company that I think is going to be a big money maker in 2021 and 2022 for me. And the way the dividend is shaking out and the share price is shaking out, I'm getting more and more excited about this company. If this company were to drop under $300 a share, I would be buying it like crazy. It would go from 4% of my portfolio probably up to much higher levels. So we'll close out Lockheed Martin and we'll finish this out with what I'm most excited about. WP Carey. I've talked about it a lot and I'll try not to make this too long, but I look at this and I continue to say that this company is still undervalued. I target this company at 7% of my portfolio and I currently am up 11.26 on a money weighted return on it, and I have $24 of that coming from market gain and about $14.50 coming from dividends. I currently own now over 10 shares of the company at an average share price of 68. And when I look at this company, anytime this company is, say, under $80 a share, it's an absolute steal. Anything under 70, once you start buying this company in the 60s, it starts to get ridiculous. And this company has not only a massive yield, but lots of opportunity for share price appreciation as well. Now, right now, this company does raise that dividend every quarter. We're about to look at that. But as of today, before they raise it in a couple weeks, they currently pay out a 1.046 every single quarter. Times that by 4, they pay out 4.184. So you divide that number by the today's share price, which is 70.39, and this currently has a dividend yield of 5.94%. Almost a 6% dividend yielding stock, and it's not even trading close to what it was trading at in its highs in 2019 and 2020. Not even close. And once again, we have the same scenario here as with Lockheed Martin. This company was trading in the 90s, and right now it's at 70. This company, since that time in late 2019, in the past year and a half or so, this company is going to continue to reinvest back into this business. And the more shares that I can pick up at these lower prices, the better. I am so betting hard into this company going into 2021. And at this point, what this article just came out with just last week, at this point, it's just pretty much confirmation bias. And this gets me so excited and pretty much just confirms everything I was speculating going into 2021 and 2022. WP Carey issues robust 2021 guidance after strong Q4 earnings beat. Now, if you look at this, WP Carey expects 2021 adjusted funds from operations, which, by the way, those of you that don't know, FFO, or funds from operations, is basically like a real estate's version of earnings per share. Remember that number that I was showing you with Lockheed Martin and with Pepsi? How the number of earnings per share is so important for me as a dividend investor? Well, the same thing goes for me with WP Carey. What's so important for me for this company to watch is the FFO, the funds from operations. So that is what is most important to me as a dividend investor. The consensus for 2021 was that they would raise it up to $4.60. Instead, they issued guidance of anywhere from $4.79 to $4.93. So let's be conservative and let's just say it's $4.80, which I think it'll probably be higher up to the $4.90 range. But let's say it's $4.80. That's still already a 20 cents funds from operations beat. And if we go further, the full year investment volume, meaning the new properties that they're buying, which, by the way, I'm about to showcase some of those already right here, they were projected to only invest about $825 million into new properties. Instead, the company comes out with earnings expectations of investing $1 to $1.5 billion. If you take the average of those two numbers, that's roughly a 50% higher increase than what the analysts were expecting. And when you look at this, like I said, this company currently pays out about $1 and a nickel, about $1.05 every single quarter. So when you think about that, that means that they're going to pay out about $4.20, but they're expected to make at least $4.80, $4.90. So that still leaves about 60 cents worth of earnings per share, or FFO, funds from operations, for them to raise the dividend, to buy back even more investment properties, to increase the rents over and over on these companies and on the properties that they have leased out to tenants. And speaking of raising rents, let's go ahead and look at what they've already announced here in the past week. And this is just the first 2 months of 2021. This doesn't count what's going to happen all throughout the rest of the year. There's no telling what's going to happen. And I'm just going to quickly go over these 3 new investments. Now, when this company does investments, it's not like they're just buying a house or a small apartment complex. They're looking at big investments. They're looking at companies that have dozens of different properties or that have been around for decades on out. And let's look at their biggest acquisition, the $75 million sale leaseback. Now, this company, it doesn't really matter what they do because they're so diversified. There's no point even trying to get into the guts of this company, what they really do. But basically, they own 20,000 acres of owned farmland in California's Central Valley. And if we go to the bottom line, if we go to the last line of this paragraph, the facilities are triple net lease, just like we talk about, so WP Carey takes on less liability under a master lease for a 25-year term with fixed annual rent increases. So once again, I talk about companies that are focused on the long term. This company is signing leases for decades on out. Let's see, right now I just turned 22. When this lease ends, I will be 47 years old. I'll be an old man, alright? I'm 22 right now. I'll be 47 when this ends. Same thing again. We have a $55 million acquisition. It's for 7 auto dealerships. Once again, if we scroll down to the bottom here, it talks a little bit about the company. If you want to read it, you can pause it. But the facilities are subject to a newly negotiated triple net master lease with another 25-year term and fixed annual rent increases. And then the last one, another $19 million sale leaseback. Once again, you have 2 distribution facilities totaling 300,000 square feet to a leading plastics distributor in North America and Europe. And once again, this is a 20-year triple net lease contract with fixed annual rent increases. And when you look at this, you realize that not only do they have 3 completely diversified properties, one of these is farmland. Another one of these is an auto dealership. And another one is, what was it, a plastics distributor? Completely different categories and industries. One of these would not take down the other. If something ever happened to, say, the plastics business, let's say the government just banned the way that plastics are produced, maybe it's bad for the environment and the government changes the way that plastics are produced, and very unlikely, but let's say this company just goes bankrupt. They go to zero, okay? Well, these other two that they just invested in are still doing just fine. They still have an auto dealership that is now producing more money than ever. They now have a new 20,000 acres of farmland that they're leasing out to. And like I said, as long as these companies are still paying rent, see these last line on all three: fixed annual rent increases, fixed annual rent increases, and fixed annual rent increases. So not only do they have this company that continues to invest in new properties that are profitable and growing and expanding, but they raise the rents every year. And if you look at this dividend information, that is what causes this company to not only raise dividends every single year, but to raise every single quarter. Every 90 days, you're going to get an increase as a shareholder. And that's what causes this awesome dividend streak of continuing to pay back cash to shareholders. And that's why the share price over time on a 5-year term is almost always going to go up as well. But in the meantime, I'm going to be betting big on all three of these companies. These are great news for all three of these buys. And when we look at a company like WP Carey, that's one that I intend to own for a very, very, very long time. It could go to $100 a share tomorrow and I'd continue to own it. The same thing with Pepsi. There's not pretty much any realistic share price that I'd sell Pepsi at. It would have to go to something just so ridiculous that it would just be stupid. And Lockheed Martin, well, that's one, who knows how long I'll own that one. That's not one that I'm anywhere near selling. The conversation probably wouldn't even start until we start to get near $1,000 a share in 2021. But regardless, guys, I love all three of these companies. If you want to follow along with me, like I said, I invite you to subscribe and get signed up with M1 Finance. It's free. You get $30 just for getting signed up. But thank you guys so much for watching all the way to the end, and I'll catch you guys next time.